Good afternoon, everyone. It's great to see everyone. It's great to be here. I'm Jeremy Fox-Geen. I'm Circle's Chief Financial Officer. And one of the critical parts of my role here at Circle and our finance team's role is building and then overseeing the reserve management infrastructure and the primary liquidity infrastructure that underpins USDC and ensures that any of our customers can always and instantly create and redeem USDC one for one. But not just create and redeem USDC, but do so around the world in their own local markets and in the major financial centers of the world. We said earlier, we're live in the US, in Europe, here in Hong Kong, in Singapore, in Brazil, with many other jurisdictions coming soon. And that redemption, that liquidity, and that interoperability is provided by us, but also by our banking partners. And so for us as a business, and for this industry as an ecosystem, the interoperability of Web3 and traditional banking money is crucial. And Circle and USDC as a stablecoin, we talk about liquidity, right, is distinguished in many ways by many things, including the core liquidity of USDC provided by that liquidity infrastructure. It's perhaps not so well known, but this is crucial to us today and will be even more so in the future. Over the last 12 months, as USDC grew, what, 10 or $15 billion, we actually created $130 billion of USDC, and we redeemed $115 billion of USDC. So the interoperability and the ability to flow money from USDC, which is this new form factor of money existing in Web3, to the traditional banking system is crucial. And it's crucial for how this industry is going to grow and expand. So I'm thrilled to be here on stage with two banking leaders from two banks that are at the heart of this intersection between digital assets and this new form of money and traditional money. To my left, we have René Michal, the global digital asset leader from Standard Chartered. And we also have Amy Yu, the Chief Executive Officer for APAC of AMINA Bank. Now, at first sight, Standard Chartered and AMINA Bank couldn't look more different. Standard Chartered, founded, 170 years ago, when Queen Victoria of England gave a Scotsman a banking license, who then promptly came to Hong Kong and opened a branch in Hong Kong, and then Shanghai, and then Singapore, and then Bombay, and then Calcutta. It's a storied institution and is now one of the 29 banks in the world designated as global systemically important banks by the Financial Stability Board. And AMINA founded, 5 years ago, as a crypto-native bank, seamlessly combining traditional banking with digital asset banking services. And in that sense, they're very different, but they have a similar thread. The vision that the combination of these old forms of money and new forms of money need to come together to ensure that interoperability through the banking infrastructure. And that's the singular vision that founded AMINA Bank, but also I think drives much of Standard Chartered's push into these markets today. And so we're talking about interoperability, and stablecoins are typically seen as a bridge, right, between traditional finance and on-chain finance, right? And so I'd ask, how have you seen these worlds collide? Maybe Amy.
Sure. So I wouldn't actually call this collide so much, but I'd focus on how I feel like over the last 6-7 years that I've been in this space, I've definitely seen the relationship between traditional finance and on-chain finance go through several phases, and particularly from where I sat, which is heavily in the capital market space in all of this. Like in 2018, when I first moved into crypto, it really felt like that was a crypto native driven narrative. We had crypto natives building this like little playground of theirs, a lot of it here based in Asia, if not here in Hong Kong specifically, and doing their thing, and you had only specific pockets of TradFi that wanted in. I feel like the TradFi players at the time were really focused on extracting value from what was mostly happening, like activity happening on centralized exchanges. So these TradFi players tended to be the HFTs, the market makers that saw the dislocations and efficiencies and wanted to come take advantage of this. They didn't have an easy time. At the time, things definitely didn't work the same way that they did in TradFi, or some things didn't work at all. But what you saw were these trading firms and market makers, they just built to crypto native specifications because that's what they had to do. And they were happy doing this. Barrier to entry at the time was pretty high, and there was plenty to go around for them if you decide to make that jump. Then you fast forward to 2021, 2022, and I think that relationship did shift a bit. I feel like one of the driving factors of that was the basis trade came in a really big way, and it brought in a lot of institutional and TradFi interest. This was a trade that they were all very familiar with. They saw it as a risk-free way to capture, some really impressive returns. I mean, we're talking 15, 20, 25, 30% on some of the venues, right? And all in an interest, in a global environment of zero rates. So, but to trade basis, you need capital and you need know-how and the access to right venues, right? And so in here, you almost see this funny symbiotic relationship where, at least I saw basically crypto native, cash poor players with the know-how were going to be borrowing cash from TradFi sources that were flush with cash, desperate for yield, but couldn't put the trades on themselves. And they're also, with this, they grew the market, and there's plenty to go around for everyone. Then you bring it to the last couple years now that I've been, with the bank, and I feel like the developments recently have been really driven by crypto wealth and demand coming from crypto economy. So now you have, this market segment of individuals, founders, successful foundations, large corporate treasuries that have done really well, and they want to now put their money to use, or at least to protect it. And they want to do this back in TradFi. So a lot of the market trends I feel like we're seeing these days, especially while crypto has been a bit more quiet, has been catering to figuring out how to give crypto wealth the access to traditional banking rails and access to traditional investment opportunities when you're in an interest rate environment of, that pays 5-6%. So I think now the challenge in these last couple of years has been really, really clear. You're going from trying to bridge permissioned to, non-permissionless. And so you're seeing this solidifying requirement to go through KYC at some stage of this transaction and offering. So I think that's how I've seen things evolve in this relationship, and it's not even really based on just what's happening in crypto, right? It's being affected by macro environments heavily. It's being affected by the amount of regulator attention to the space, and also just the size of the crypto economy as it grows.
Rene, what's your perspective?
Well, so I agree with what Amy said, and I think that there's a broader context though where the things that stablecoins in particular on public chains can solve, whether that's bridging into DeFi protocols and providing liquidity there, or whether that's simply on the centralized exchange, I think that we have had to have mechanisms for exactly the capital markets activity that you've been talking about, and that has very much been what stablecoins have solved for. I do think we're starting to see that change, where the use case is much broader in moving into payments, into difficult access markets and things like that. And so yeah, again, what's the collision point? I think what's weird to me, right, is if you look at the Bills of Exchange Act of 1883, that's obvious for a banker to quote that. It describes bearer instruments, and the mechanics of that are actually remarkably similar to the way that a stablecoin works. And so what I've found super interesting about this is it feels like we've tried to overcomplicate this a bit, because we've kind of had these mechanics all the way along. But having said that, what you've got is very functional construct that's being deployed across lots of use cases and is definitely projecting fiat money into blockchain-based spaces and having real commercial impact.
That's a very interesting lens to take on it, right? When you're saying we've had these things all along and perhaps we're overcomplicating. I mean, after all, stablecoins are just a new form factor of money. Mm-hmm. There's no particular radical invention. The new technology is fascinating, building on blockchain technology and being able to bring money into the internet and benefit from all of the power of the internet is a truly profound innovation technologically. But the stablecoin itself is a new form factor of money. And so maybe as we talk about that, where are you seeing the most adoption with stablecoins today, and what are some of the trends that you're most excited about?
Yeah, so just to follow on from what I was saying before, I actually think the commercial use cases are really interesting. The two that I would call out that we're certainly seeing at an early stage is accessing difficult markets. So if you look at correspondent banking over the last decade or so, we've seen a retreat from the Caribbean, from the Pacific, from Latin America, and from Africa, basically the global south, making access to markets which are resource rich complicated from a traditional money perspective. And so I think stablecoins are emerging as a way for corporate treasurers and finance heads to solve for these problems. And we're certainly seeing more and more of that, both in dollar-denominated stablecoins like USDC, but also in non-dollar denominated stablecoins. And then speaking of non-dollar coins, there's a really interesting construct then where if you are already doing that kind of activity, why do you not get access to real-time FX by basically just swapping stables with stables at an FX rate? We see that very much through our Zodia Markets business. There's a lot of demand for this kind of thing, and so I think that these are really interesting, what I would call early indicators of adoption, things to watch closely.
Amy, what are you seeing from your perspective as the places where stablecoins are really getting traction?
I think, well, the obvious one that's been there the whole time has been the use case of moving funds within crypto capital markets. That one's obvious. But adding on to what Rene was speaking about in terms of cross-border payments, particularly with developing economies, I think it's really cool also to see that stablecoin issuers like Circle, you guys have proven that this is something that the market needs, and there's a big project that the BIS have recently announced, Project Agora, that's aiming to bring cross-border payments between banks, actually, to tokenize cross-border payments across, I believe, 7 central banks and a short list of commercial banks across various backgrounds, and to bring these onto a shared programmable infrastructure. And I think both AMINA and Standard Chartered are part of this project. And what this project is going to end up doing is it's going to, one, allow for, right now, like the message, when you send a transfer via your banks, like the message that accompanies it that tells the bank who to credit and how, right? It doesn't travel with the money itself. And a lot of people, you notice it when you're trying to deal with your own banking, but until you're at the bank, you also don't see how disjointed it is. It doesn't travel together. That's why your funds get bounced back. Well, your messages is sitting where, which bank is it at, what level is it at. And with this tokenization project, what Project Agora is going to do is be able to let that message and funds travel together, and then also have atomic settlement between the sender of the funds and the receiver of the funds, which is pretty cool. And a step further that maybe only banks find really exciting, because we're it's a big pain point for us. But it's going to allow for the streamlining of KYC checks, processes, the costs associated to it. So right now, every step of the way, every single correspondent bank involved in your payment has to do all these checks themselves. And so I think as a consumer, I'm pretty excited to see, the work that Circle is doing is pushing the traditional banking sector to finally address these problems.
Yeah, that's fascinating. You kind of talked about the excitement of banking plumbing and the separation of the message from the money, which is, if you're into banking, is a truly exciting innovation kind of within Project Agora. And even more so when you realize that the fundamental money movement infrastructure today in cross-border banking, so the SWIFT payment system, for example, is based on legacy 1960s text messaging technology, right? Which is why it breaks all the time. And the idea of innovation in digital assets here is so important. And we've touched on kind of regulation earlier in these conversations, but when you're thinking about the critical role of banks in leading digital asset innovation and the importance of regulatory clarity, right? How does that matter to your institution, Amy?
Yeah, I think what I've really learned the last couple of years too, moving into this part of the crypto ecosystem, is that banks are really more or less, as a privilege or as an extremely heavy onus, we're like that final layer of permissioning through our regulated KYC checks to us sitting as that final layer on the fiat banking rails, or being that extreme stamp of approval in whatever is trying to come out into the market. And so in that sense, I feel like we're really the gatekeepers that allow whatever moves on-chain, between on-chain and traditional finance. That comes in the form of, one, being able to just even support the bank, the businesses that are innovating in this space. Without the support of a simple bank account, they're not going to get started. They're not going to be able to apply for their licenses. They're definitely not going to be able to scale and grow and then be able to have access to the investment solutions that they want to reinvest. And secondly, also on the other side, I feel like a lot of the world still wants to see a bank involved in the direct access of, or the distribution of a specific even third-party fund, or a new crypto investment concept like staking, restaking. A lot of the world still wants something to have gone through a bank DD process before they're actually going to fully adopt it. And banks are basically synonymous with regulation, right? So I think without regulatory clarity, it's super critical for us. And to that point, I think Swiss crypto companies and blockchain companies have been really fortunate to have a regulator like FINMA from all the way back when, to have that foresight, forward thinking, to give out these crypto banking licenses from 2019, having really clear crypto classification, crypto tax treatment, these kinds of things to allow for a synergistic and non-fearful relationship between the Swiss banks and these innovative crypto businesses. I think that, it's no small coincidence that you see now there's over 1,000, I think, blockchain-related companies in Switzerland, and most of them are not actually Swiss. They're coming from overseas, right? Setting up offices and headquarters in Switzerland because of that banking support.
Yeah, and so you've got regulatory clarity in Switzerland, and that enables the safety and soundness, and that needs to be at the heart of the banking system. And so as you think about that, René, right, so innovation, regulatory clarity, and how actually regulation can drive innovation, how does Standard Chartered view that?
So I guess I want to tackle this from two angles. So one is from a regulatory perspective. I actually think, particularly large banks that cover multiple markets like Standard Chartered, we've got a responsibility to kind of lead innovation and not wait for regulatory clarity. And not to undermine the point on the Swiss regulator, because I think that's well made, but across the markets in which all of us operate, there is a lack of regulatory clarity. And I'm always a bit allergic to waiting for someone else to innovate, particularly if it's the regulator. So our job is to be on the front foot, engage thoughtfully, proactively help solve problems, operate as if we are regulated. I think there's another point that I want to make, though, which is in the regulatory discussions and the broader central bank discussions, there is a sense that we can regulate everything that ever happens with any kind of money, right? And I think in some ways that's not quite true, because corporates and individuals are not regulated, and they don't care, and they just want to solve money problems. So if you squeeze down on all of the crypto activity that's happening in regulated firms, that ends up going outside the regulatory purview. But it's not going to stop the activity from occurring. So our view is actually banks have a responsibility to be that bridge and to be a bit of an extension from a regulatory perspective to kind of sit there in that space and enable all of the innovations that crypto and blockchain and digital assets provide so that the people who need to use the money can use the money.
And people are going to use it, and we see that
Correct.
across the world, where people want to solve their problems and do their things, and we need to bring that kind of into a safe and sound perimeter when it comes to banking. I mean, it's interesting, when Circle launched USDC, we had to walk into the regulatory door and ask to be regulated because they didn't understand digital assets. This was in 2018, and it was very novel and it was very new. But
Could have got a banking license.
We decided not to for a bunch of reasons we won't get into right now. But we've built our company on the view that money is and always will be a regulated activity, and kind of the partnership that with banks is crucially important to that. And so just as we wrap up, I might just ask one last question. I think I just have a moment to do so. It's like, why is now the time for banks to go all in on digital assets and stablecoins? René?
I mean, it's an interesting phrasing of the question. I just don't think we've got a choice, right? Digital assets are fundamentally transforming the way that financial products work. And as you say, we've got infrastructure that was built or that's based on technology from the 60s and 70s. There's a perception that account-based banking, the way it exists today, has been around forever. It hasn't. It's been around since we invented databases. And so I think we've got this new technology stack that is reshaping the infrastructure on which we build financial products, solving problems that were not solvable with centralized databases. So we have to learn how to do this stuff with the new technology. But to that point before, banks are boring, money's boring, doesn't change, it's just new tech.
Right, technology upgrade. Amy?
Yeah, well, I think since we were licensed from the start as a crypto bank, I would say that we've pretty much already gone all in. It's our USP. But I think it's super encouraging to see, heavyweight banks like Standard Chartered moving in the space in a big way. There's certainly a lot of demand for, not only bank accounts, but all of the services that the banks can provide. And, we could use the help.
And so look, just to kind of bring it back down, right? Stablecoins are at the heart of this new infrastructure. You guys are both building on that. I think that's critically important. It's important to what we do. It's important to the entire industry. So thank you, Amy. Thank you, René. It's been terrific to talk to you. Thank you, everyone.
Thanks, Jeremy.